Let us take our discussion forward and talk about some more finance numerical questions which can be practiced by you for RBI Grade B 2018 examination. So in this lecture, we are going to take some more questions so that you can practice similar kind of questions by finding them out from the internet. I'm offering a free 20-day course for RBI Grade B 2018 examination. You can subscribe for the free course by going on my website www.anujindal.in. It will help you understand as to how am I covering the entire syllabus, the approach that I follow, and will help you decide whether to enroll in the course or not. So let's start. We've already covered 3-4 questions. We'll take the discussion forward and talk about some more questions. So this was the first question that we covered last time. Second question, we have covered this also, and we covered this question also. Let's go with the fourth question, which talks about tax burden ratio, and it's a very interesting question. The question says, which of the following will most likely result in an increase in a company's sustainable growth rate? Now, if we want to answer this question, we need to understand, or we need to know how to measure sustainable growth rate of a company, and then we need to measure that sustainable growth rate and identify whether which of the following three is the right answer. Sustainable growth rate, the formula for sustainable growth rate, let's first of all understand that sustainable growth rate, the formula is retention ratio, that is the amount of money after paying off all the expenses, the amount of money that is kept by the company, retained by the company for its own investors and into return on equity. So this is the formula for sustainable growth rate. We need to break it down, retention ratio and return on equity. So if we break down return on equity further, we will see that return of equity can also be written as tax burden into interest burden, EBIT margin multiplied by asset turnover, and then you further multiply it with the level of leverage in the economy. So this entire formula broadly means that as tax burden increases or tax burden ratio increases, return on equity increases. Now this might sound a little confusing. We'll break it down further. As tax burden increases, return on equity increases. As interest burden increases or interest burden ratio increases, return on equity increases, because these are directly related to each other and not indirectly related to each other. EBIT margin, as it increases, return on equity increases. Similarly, asset turnover as well as leverage are also directly related with return on equity. Now we have to find out these two things, tax burden ratio and interest burden ratio. As tax burden ratio increases, what this means is that a higher tax burden ratio means, let's first break down tax burden ratio. Tax burden ratio's formula is net income upon EBIT. Now, as tax burden ratio increases, net income, that is income after taxes, upon earning before interest and taxes, the ratio has increased, which means that the company or the individual has more money after taxes. This means that a higher tax burden ratio, when the tax burden ratio increases, it means that the net income is increasing faster than EBIT, which means that, let's say, if the EBIT is 100 in one instance and let's say 150 in another year. Let's say tax burden ratio here is 20% and tax burden ratio here is 30%. Now this does not mean that 20% have to be paid as taxes. This means a higher tax burden ratio means that 20% of this, that means 20 rupees, can be kept as net income. Similarly, a higher percentage as tax burden ratio, that is 30% of, let's keep it 100 only, 30% of 100, which means 30 rupees can be kept as net income. So here what we are saying is a higher tax burden ratio actually increases the after tax profits for the company and therefore increases the sustainable growth rate. Lower interest burden ratio, interest burden is also directly related with return on equity, therefore a lower interest burden ratio means lower after tax profits or after interest profits for the company. EBIT margin, asset turnover and leverage. So all these matter, plus the retention ratio of the company also matters. Now a higher dividend payout ratio is not connected with return on equity, but it is connected with retention ratio. So when you have a higher dividend payout ratio, it means that the company is paying out or distributing whatever it is earning, whatever net income it has, a higher proportion of that is being distributed as dividends to the investors. This means retention ratio is low, because what is retention? Retention is the ratio or proportion of after tax profits which is being kept by the company with itself. For example, the net income of the company is, let's say, 100 rupees, and retention ratio is, let's say, 50%. This means that rupees 50 is being distributed as dividends, and the remaining 50 is being kept or retained with the company. Now when the retention ratio reduces or dividend payout ratio increases, which means that now the company is distributing, for example, rupees 60 as dividends and keeping only rupees 40 as retention, or retaining only rupees 40 with itself. So retention ratio increases, beneficial for the company. Dividend payout ratio increases, not beneficial for the company for sustainable growth rate of the company only. So the answer is higher tax burden ratio. Very easy question. Let's come to the next question now. Now this is a very interesting question, because the difference between coupon rate and interest expense is brought out here. The question says on 1st January 2011 the market rate of interest on companies bonds is 5%. What is it? Market rate of interest on a company's bonds. We are given interest rate, that is market interest rate, as 5%, and it issues a bond with the following characteristics. Find out the interest expense. So we have to find out the interest expense, that is what amount of money or interest is the company going to spend in this year. Face value is 50 million. Coupon rate paid annually is 4%. Time to maturity is 10 years, and issue price is 92.28 as against $100. Now what is missing here is that the company follows IFRS standards, which means International Finance Reporting Standards are being followed by this company. As per IFRS, interest expense is calculated based on the number one, market interest rate, which is 5% here. And secondly, it is calculated not on the basis of issue price, but on the basis of the nominal price, but on the basis of the issue price. Sorry. So the issue price is 92.28 and the nominal price was rupees 100 or $100. So it does not matter what the nominal price was. What matters is the issue price. Now, if we consider the issue price as against the nominal price, first of all, we have to identify the entire issue value or the cost of issuing these bonds. So a total of 50 million worth of bonds were issued, nominal price being $100. If we take the issue price, it becomes 0.9228, and then we multiply it by 50 million, and our answer comes out to be 46.1 million. So the nominal value of the issue was 50 million, but we could raise only 46.1 million because the issue price was lower than $100 or the nominal price. So what this means is that, for example, you go to the market. This is an individual. This is the market. You go to the market and you say, I want to issue bonds and I want money in return. The nominal value is $100. The bank says you do not have that much value. Not the bank, the market says you do not have that much value. So we are going to pay you only 92.28 per bond. And whatever bonds you want to raise, you will get the money. So I want to raise a total of 50 million worth of bonds. That means of $100 each. That means 0.5 million number of bonds. So you multiply 0.5 with 92.28 and you come with the answer, that is 46.1 million. This was the amount that I as an individual could raise from the issue of these bonds in the market. Now whatever I have raised 46.1 million, and I have to pay certain interest rate on this. How much interest? I have to pay 5% interest rate and not 4%. Although you might feel that it is supposed to be 4%, but we are considering only International Financial Reporting Standards, and this can very well be asked in the exam because now the country is moving towards IFRS. So when we are talking about IFRS only, we use market interest rate and we use the issue price rather than the nominal price. Whether on the other hand, if we are using Indian standards, the older standards of financing, then we use the coupon rate to find out the interest expense, and we use the nominal value of the issue of bonds that we have made. So what we're going to do here is we are going to multiply 5%, or we are going to find 5% of 46.1 million, and the answer comes out to be $2.386 million. So this is our answer. Let's come to the next question. Question says, what is the most appropriate conclusion an analyst can make about solvency of the company? So you need to be very well versed with how to calculate solvency of a company. There are 2 years given and certain numbers: short term borrowings, current portion of long term interest bearing debt, total shareholders' equity, EBIT, interest payments, and operating lease payments. Now, first of all, let's have a look at the formulas of these two things: debt to equity ratio and fixed charge coverage ratio. Only then can we move forward. Debt to equity ratio formula is total debt, whether long term or short term, upon total equity of the company. Also, fixed charge coverage ratio formula is EBIT plus interest fixed interest payments that the company has to make upon fixed interest payments or fixed payments that the company has to make plus interest payments. Interest payments are taken separately, they are not counted under fixed payments that the company has to make. So this is the formula for fixed charge coverage ratio, and this is the formula for debt to equity ratio. Now that we have understood the formulas of debt to equity and fixed charge coverage ratio, find out which one is right. Now debt to equity ratio says total debt upon total equity. Total debt here is short term borrowings, current portion of long term interest. So we have total debt as these three: short term as well as long term debt. This is not a debt, this is an expense. So you need to differentiate between debt and expense. This is an expenditure, whereas this is an expense. Interest payments as well as operating lease payments will not be counted. So we have total debt as 2240 plus 2000 plus 12,000, and for the year 2010 we have 5400 plus 1200 plus 9000. This is our total debt. Equity is 23250 and 21175. EBIT is not as yet part of the equity. EBIT becomes a part of equity only when, after interest, the net income is calculated, and that net income or net profit is provided in the balance sheet. I hope you understand what I'm talking about. So debt to equity ratio, if we find out, it is 74% in this year, in 2012 10, whereas it comes down to 70% in 2011. So it is decreasing. When debt to equity ratio decreases, which means that as a portion of equity, if equity is 100, then debt reduced from 74 to 70. This is what it exactly means. 74 was debt in the year 2010. In 2011, debt reduced to 70 out of 100, or 70% of equity, and therefore this is the right answer. Now let's have a look at other options also. Deteriorated because debt to equity ratio increased. This is wrong because debt to equity ratio has actually reduced. So this can be eliminated. Improved because fixed charge coverage ratio increased. Now fixed charge coverage ratio, as we saw, is EBIT plus fixed charges, that is lease payment, upon fixed charges plus interest cost. Interest cost is interest payments that the company has to make. Now when fixed charge coverage ratio increases, it means that the company has better EBIT as well as fixed charges now. So it is in a better position to pay off its loans, to pay off its liabilities. However, in this question, fixed charge coverage ratio has not increased. If fixed charge coverage ratio had increased, then this answer also would have been right. But fixed charge coverage ratio remained the same at 2.1 in both the cases. So EBIT is 3850, fixed charge is 800, and fixed charge plus interest expense is 855. We keep all these together and we find out fixed charge coverage ratio, which has actually not increased in the 2 years, it has remained the same. Let's have a look at another question which is related with cash flow statement. Very interesting question this is, and very conceptual in nature. So cash flow was asked in the year 2017, but unfortunately we do not know what kind of question was asked from cash flow statement. So we are going to go forward and cover a lot of conceptual questions. The question is, which of the following will most likely increase a company's operating cash flow. There are three kinds of cash flows: operating, financial, as well as investing. Operating, financing, and investing. These are the three kinds of cash flows. The question says which of the following will most likely increase a company's operating cash flow. The choices are an increase in day sales payable, gains on the sale of long term assets, and use of operating leases versus financing leases. Now let's have a look at all the option choices. B says gains on the sale of long term assets. Operating cash flow deals with only the cash flow related to operations of the business, and operations of the business do not involve sale or purchase of long term assets at all. So, sale of long term asset becomes an investing activity, and not even a financing activity, because financing is when you're financing something, but gain on sale of long term asset becomes an investing activity. Next is use of operating leases versus financing leases. For this lease, you have to pay out regular charges, and those charges are going to be deducted from operating cash flow statement. So when you have taken an operating lease, you have to pay, let's say, monthly charges or monthly payments or monthly rent of some kind on this lease, and therefore that is going to be deducted from your monthly cash, and the operating cash flow will reduce. On the other hand, statement A says day sales payable. Now, what is a day sales payable? Day sales payable is the amount of time that you take. Let's say you used to take 15 days to pay for tires of the car that you assemble. You assemble a car, this is your business, assembling the car. And for assembling the car, you need tires. Now, you uh, get those tires from some other company, let's say MRF is giving you tires, and you get a 15 days credit on these on making the payments for these tires. So this 15 days is the day sales payable. Let's say it increases to 30 days because of some reasons. The MRF is not doing very well. It wants to sell you no matter when you make the payment. So it gives you a credit of 30 days. This means day sales payable increases to 30 days from 15 days. This means now you have more money in your hand because you have to pay after 30 days. So whatever you had to pay in March, for example, you purchased something on 2nd March, a consignment of tires or 2nd March. You have to pay for it on 2nd April. This means after 1 month. So before you had to pay on 17th March, but now you have to pay on 2nd April. This means you have more money in your hand in a financial year and more cash flow. Therefore, operating cash flow increases with an increase in day sales payable. So cash flow is a very, very important concept. Go through all three statements, all three parts of the cash flow statement, that is operating, financing, as well as investing activities under cash flow statement.